Hello everyone. In this lecture, we're going to talk about valuations. In the first lecture, we understood the concept of investing through the investor's pyramid. Then, we saw how to make a good financial plan to ensure that you are able to generate that surplus cash to invest. In the third lecture, we talked about the different kinds of risks that you would face in investing. By now, I'm sure that you have become a good enough investor to not lose your hard-earned money. And so, we can now move on to discussing how actually can you make money. The crux of investing is valuation. The day-to-day work of an investor involves finding undervalued assets and investing in them. That's as straightforward as it gets. In this lecture, I'm going to tell you exactly how to value an asset. We'll see how to value different types of assets, stocks, bonds, real estate, and commodities. What is valuation? In one simple word, valuation is comparison. It is nothing else, it is nothing more. Even the most complex financial models are built to achieve only this one basic purpose. The only way in which we evaluate anything in life is by comparing it with something else, be it choosing food from a menu or choosing a person to get married to. All we can do is compare. The same goes for investments. Investing is all about foregoing present benefit for a potentially larger future benefit. So, the two things that we need to compare are what current benefit am I foregoing and how much benefit do I expect to get in the future. Then comes the question, is it adequate? The only way to answer this question is by comparing it with our next best opportunity. If it is better, we go ahead. What I just explained is the basic philosophy behind a valuation. To understand exactly how to do a valuation, we'll have to look at various investments individually. Bonds, debentures, debt, fixed deposits, they're all fundamentally very similar products. They are loans that you give to someone. When you're giving a loan, what you earn in return for the money you give is interest. The amount that you give and expect to receive back after a fixed period is called principal. The way to evaluate a loan is by calculating the rate of interest that you are earning on the loan. Rate of interest is the interest income earned in a year divided by the principal amount. These calculations are very simple when the principal amount that you initially give is the same as the principal amount that you receive on loan maturity. But when you invest in bonds that are traded in a market, the amount that you pay for them may not be equal to the amount that you will receive on maturity. In this case, the calculations become a little bit more complex. For listed bonds, there are two types of interest rates. One is called the coupon rate and the other is called the yield to maturity. It is extremely important to understand the difference between these two. The coupon rate is what the initial investors would have earned if they had invested in that bond at the face value. However, if you've bought those bonds from a market at an amount that is different from the face value, the interest rate that you will earn is called the yield to maturity. How to calculate yield to maturity is something I'll explain in detail in the lecture on investor math. Stocks or equity are nothing but partnership share in a business. If you own 1000 shares of HDFC Bank, you are a 0.000042% partner in the company. As a co-owner of the company, you are entitled to a share in the profits. Companies distribute part of their profits as dividends and retain part of it for future growth. As an investor, it is important to understand how much profit a company is making and what your share in those profits is. The profit attributable to a single share is called earnings per share or EPS. This is published in a company's annual report and all its quarterly reports. You can also get it easily on Yahoo Finance or Google Finance. While valuing stocks, we need to look at the price we are paying for the stock in relation to the earnings of that stock. For doing this, we use a ratio called the price to earnings ratio or simply the PE ratio. It is nothing but the current market price of the stock divided by its latest annual earnings per share. The higher the PE ratio, the more you are paying for the stock. An important caveat here is that you cannot compare PE ratios of different companies in pure mathematical terms and invest in the company with the lowest ratio. This is because stock prices are driven not just by the current earnings, but also by the future expectation of earnings and the potential volatility of those earnings. There is no limit to how deep you can go into understanding these two factors. The better you understand them, the better equity investor you will become. Going into how to develop your abilities in projecting company earnings and understanding earnings volatility is really out of the scope of this lecture series. It is so complex that an entire lecture series dedicated to it may also not be enough. Real estate. I must confess that I've never invested in real estate myself, but that's not going to stop me from talking about it. One can earn two types of income from real estate: rental income and the appreciation in the value of the property. It is commonly perceived that property prices move only with the demand and supply, and they do not have any fundamental driver. This is not true. There is a fundamental linkage of property prices with rental yields. The current rental yield and the future expectation of rental yields drive property prices in the long run. Calculating rental yield is the same as calculating interest yield. Rental yield is equal to the annual rent divided by the market value of the property. The basic thumb rule in real estate is that rental yield plus property appreciation should be at least equal to the interest rate that you could earn on debt. For example, rental yield on properties in Mumbai is generally around 2% these days. Interest rates on FDs is around 9%. What this implies is that one needs to earn capital appreciation of at least 7% every year on his property to justify his investment in that property. Commodities or bullion. Had I been making this lecture series 200 years ago, gold and silver would have been the only two things I would have been talking about. These two metals have been the default investment option for centuries. We invest in gold because it is the best hedge against inflation. Earlier, all money used to be gold. But ever since money started getting printed on paper and started losing value over time, gold became an even more attractive investment option. While metals such as gold or silver are expected to beat inflation in the long run, there is no guarantee that this will happen over a specific period of time. This is because the forces of demand and supply are such that the price of gold increases substantially on even the slightest expectation of inflation in an economy. It is important to avoid entering such a commodity when the price is unreasonably high. One needs to really study the demand and supply patterns of that commodity to time his investment right. If you think that is not your cup of tea, you would be better off investing small amounts in the commodity over a long period of time as part of a plan. Investing through investment funds. Now, most of you may be thinking right now that I'm asking you to do things that are way too difficult for you. I fully understand that valuing stocks, studying demand and supply patterns of gold, or predicting inflation are not things a non-finance professional can expect to do with a great deal of success. Hence, one can always invest through investment funds. An investment fund is a scheme where a lot of investors' money is pooled and invested by professional fund managers. The most common type of investment fund is a mutual fund. But there are many more, such as private equity fund, pension fund, real estate investment trust, and so on. The key to investing through an investment fund is to understand what exactly the fund does. Too many people that invest through funds blame their fund managers if they lose money. In most cases, this rage is unjustified. Fund managers play only a partial role in the investing process, while the investor continues to bear the risk and responsibility for the rest. On paper, a fund invests through a mandate set by its investors. However, in actual practice, the mandate is decided by the fund managers themselves at the time of inception of the fund, and this is communicated to the investors through the offer document. This mandate very clearly spells out the role and responsibility of the fund manager. Anything that's not in the mandate is implied to be the investor's call. Let me explain this with an example. Let's go back to my friend Shiv, who recently invested in India Blue Chip Fund. He saw that this fund had achieved good returns over the past few years and expected it to make money in future as well. But the fund underperformed after he invested, falling by 20% in just 1 year. Shiv was extremely angry and he liquidated his investment. Being a tech-savvy person, he also posted a few nasty reviews about the fund in a few online forums. He also wrote an angry letter to the fund manager, threatening to sue the fund for his loss. To his surprise, the fund manager replied saying this: "Dear investor, thank you for showing faith in us by investing in India Blue Chip Fund. We are pleased to announce that we have once again been the best performing blue chip fund in India for a fourth consecutive year. We have outperformed our benchmark index by 10%. We believe that we have once again proved ourselves worthy of the trust that you have placed in us. We look forward to your continued support and patronage as we strive to set new standards in the industry. Thank you." The fund manager sounds crazy, doesn't he? Actually, he is not. The fund manager is absolutely correct in his assessment. It is Shiv who has not understood what to expect from his fund manager. Let's see what's really happening. India Blue Chip Fund's offer document clearly states that the fund will invest in the top 100 companies in India as defined by the BSE 100 index. Within this set of companies, the fund manager will try to find the best companies to invest in, and he will try to outperform this benchmark index. The fund will keep 80 to 100% of its corpus invested in equity shares of BSE 100 companies at all times. The balance money may be kept in short-term liquid investments. In the year in question, the BSE 100 index fell by 30%, while India Blue Chip Fund fell only 20%. Thus, the fund manager was right in saying that he had beat the market by 10%. What Shiv failed to realize was that the fund manager was responsible only for beating his benchmark index. The rest of the decision was Shiv's responsibility. When Shiv invested in the fund and expected it to increase in value, he was taking the following calls. First, that the equities as an asset class will go up in value over the next 1 year. Second, that within equities, blue chip companies or the top 100 companies will do well over the next year. Third was that India Blue Chip Fund will invest in the best companies among those 100 blue chips in the benchmark index. However, of these, the fund manager was responsible only for the third call, while Shiv himself was responsible for the first two. And as things eventually turned out, the fund manager did his job well on the third point. It is Shiv who went wrong with his calls on blue chips. This is what I mean when I say understanding the mandate within which the fund manager operates. In most cases, broader decisions that lie with the investor are choosing an asset class such as equities or debt and choosing a subgroup within the asset class. That could be a sector such as telecom or pharma, or it could be a benchmark index such as blue chips or mid caps. The fund manager will take the role of choosing the best assets within that specific asset class or subgroup as defined in his mandate. This is why it is extremely important to follow the economy, track the industries that you're investing in, and be aware about what's happening in your portfolio. There is no easy work around this one responsibility. You may ask me, why can't I just give my money to a fund manager and let him take all my investment decisions right from the asset allocation stage? The answer to that is unpleasantly simple. Investing as a discipline has just not evolved to that extent where a fund manager can take on such level of responsibility and be confident of generating good results year after year. As I said earlier, investing is about valuation, and valuation is comparison. We can scientifically compare apples only with other apples to say which one is better. But when we compare apples with oranges and ask which one is better, it is a matter of personal choice, not a scientific opinion. Similarly, in investing, we are reasonably good at comparing two automobile companies and saying which one is better. But is it better to invest in Tata Motors stock or to invest in an apartment building in an upcoming Lodha township? Nobody can answer that for you. It's a matter of personal choice.